Let's Get Down to Business is presented by Bravo, the marketing arm of Ash Brokerage Corporation, the practice enhancement company. All this week, it's the top sales ideas for 2013. And on today's show, how to sell longevity risk in retirement. And with me today is top of the table and MDRT platform speaker, Tom Hegna. Hi everyone, I'm Steve Savant, syndicated financial columnist and contributing author to Backroom Technician. Let's get down to business. Well, welcome to the show, Tom.
Hey, thanks, Steve.
I haven't seen you in a little while.
Yeah, no, it's great to be back.
You spoke at MDRT this year again?
Yes,
How was that?
It was fantastic. I spoke main platform at NAFA as well.
And when you get up there, people are now anticipating. You're known now. You're on the circuit. You're one of the top guys in the United States. How is it for you when they're ready to hear your story? And all this week we're going to talk about a lot of your wheelhouse issues.
Yeah.
You know.
So, I mean, I've got to come up with something fresh and new all the time, but I've also got to keep drilling in the basics. I mean, these basics don't change. And so it's a challenge keeping the message fresh, but really drilling in on the basics so that everybody understands how to solve these problems. You know,
we're talking about longevity risk on today's show, and we have a lot of things to think about on longevity risk. And I think even though we've talked about it on the show before, I write about it, I am always questioning. When I read the questions and answers from my blogging, I don't know if they understand it. Our advisors really understand the power of longevity and how it works in tandem with insurance products.
If you look at all the risks in retirement, there's a lot of risks in retirement.
Oh, yeah.
There's market risk, the market can crash. There's a risk of potential inflation, deflation. You might take too much money out. The order of return risk, there's regulatory risk, taxation risk, long-term care risk. But out of all of these risks, there's only one number one risk. The number one risk is longevity risk. Why? Because longevity is not just a risk. It's a risk multiplier of all these other risks. See, the longer you live, the more likely you'll need long-term care. The longer you live, the more likely the market will crash. The longer you live, the more likely you'll take too much money out. The longer you live, the order of returns could send you in a death spiral if you're in a diversified portfolio. So of all the risks out there, longevity risk is the number one risk. So if you want to retire properly, what all the research, and I mean all the math and science shows, is you must take longevity risk off the table.
Well, Tom, I'm interested because, you know, we always tell our clients we want you to take a risk tolerance test, and they do it based on their beta, what they're exposed to, how much can they stay in the market, and what their asset allocation model is. But I'm wondering, should we start doing mortality calculations on how long we think this client's going to live based on their medical and their family history?
Well, I mean, you could do that. The thing is that nobody knows how long they're going to live. And even if you did all these calculations on how long somebody's going to live, you still don't know. Like, their parents could have died early, and they could still live a long life. So what I tell people is you've got to plan to have income to age 100 and beyond. You really have to have guaranteed lifetime income.
Well, let's talk about that because, you know, I mean, I think I just heard Willard Scott on the Smucker's jar. Basically, you know, age 100 now is the target for longevity risk. I mean, you really see this going there.
Yeah, and you see, here's the deal. Stocks can't take longevity risk off the table. Bonds can't do it. CDs can't do it. Managed money can't do it. Mutual funds can't do it. The banker can't do it. The broker can't do it. There's only a few things that can take longevity risk off the table. A lifetime income annuity, which many people call a SPIA, that can do it. A deferred lifetime income annuity, which many people call a DIA, that can do it. An income or withdrawal benefit rider from a fixed, variable, or indexed annuity can do it, but that's it. What do all those products have in common? One word: annuity. What all the research, and I mean all the research on retirement shows, is you must have an annuity in your portfolio. Why? Because only an annuity can take longevity risk off the table. Why? Because only a life insurance company can issue an annuity. Why? Because only a life insurance company sells life insurance to be on the other side of that risk. And that's what people don't understand, is that the life insurance company sells life insurance where the risk is people die too soon. They sell lifetime income where the risk is people live too long. Because the insurance industry is on both sides of that risk, they're the only ones that can neutralize longevity and mortality risk, and that's really the miracle surrounding this, what an annuity can do to take longevity risk off the table in retirement.
Well, I'm thinking a lot of our advisors who are securities are watching our show right now. They're still getting used to our discussions on insurance products and so forth. But when you talk about this, when we're looking, are we talking about, is it a third of a client's portfolio? Is it half of their portfolio? What are we looking for to protect this risk you're talking about?
The solution is really quite simple. Find out what their basic expenses are. Ask them, how much money do you need to live your normal retirement? That should all be covered with guaranteed lifetime income. Now, what counts? Social Security counts because Social Security is a lifetime income annuity. A pension counts because it's a lifetime income annuity. See, those are both guaranteed paychecks for life. But whatever the shortfall is, that's where an annuity product from an insurance company fits, is to cover their basic expenses. And again, I'm not making this stuff up. Anybody who wants to do the research, stocks and bonds just can't do it.
Well, if I'm starting to target, and I think the last 4 or 5 plans I've seen don't go any farther than age 85.
Right.
And now you're saying, oh, we may be 15 years short on this.
Yeah. Well, and think about it. To all your securities representatives, I would challenge them. Look at the bottom of the page of their income plans. It'll say something like this. We've run 10,000 Monte Carlo simulations, and there's a 77% chance your money will last you to age 90. See, the brokers all use age 90 in their Monte Carlo simulations. Age 90 has a 63% chance of failure. Now, if you're getting on a plane today and you're going to fly, like I'm going to fly to Minneapolis later on today, would you get on a plane if they said, ladies and gentlemen, there's a 63% chance we're going to crash on the way? You wouldn't do that.
No.
And so these Monte Carlo simulations are not taking longevity into account. And if people did live to be 100, 105, 110, there's not a single Monte Carlo simulation that would stand up.
If I have some selections, because you said annuities, but within that annuity you said, oh, interest rates driven SPIA, interest rate driven DIA. Oh, and we added indexing onto that. Is there anyone by science, by math, that is better from a longevity risk heading out to age 100?
Well, I think the SPIA and the DIA, okay, have the most mortality credit. So like income annuities would pay the highest amount of mortality credit. So maybe in the next section we can get into that a little deeper.
When we come back from the break, we're going to talk more about the risks of retirement and Tom's #1 retirement book, Paychecks and Playchecks. Don't forget, you can view all of Tom's videos on TomHegnaOnDemand.com. And while you're online, don't forget to sign up for your own 30-day free trial offer from Backroom Technician. Just go out to their site, brtnow.com/trialsignup.aspx. We'll be right back, right after the break. Back in the day, life insurance professionals were called field underwriters. Then, carriers trained their field force in the basics of life insurance underwriting. Today, the insurance industry doesn't educate the agent population as they once did. But now you can have the Informed Risk Guide at your fingertips so you can illustrate a reasonable rate class for your life insurance prospects. Just request your copy of the Informed Risk Guide at downtobusiness.ashbrokerage.com. It's free from Ash Brokerage, the practice enhancement company. Well, welcome back. I'm Steve Savant with Tom Hegna. And remember, you can watch all our episodes of Let's Get Down to Business, including my weekly consumer show, Steve Savant's Money, the name of the game, right out at ashbrokerage.com. Just click on the show logo, it'll take you right out to the home page. And just a heads up, before moving forward with any of the ideas on our show, always consult your tax advisor or legal counsel, as well as your broker-dealer compliance officer. Well, let's get down to business. We're talking about longevity risk in retirement and Tom's new book. And by the way, let's talk about this, because I love this as a marketing tool. Tom, tell the advisors that are watching our show what they could do with this book for their own practice.
Well, I mean, you can customize the book. So the book will still say Paychecks and Playchecks by Tom Hegna, but it'll say with contributions from Steve Savant. And then you get your picture on the back of it, and you get to explain why retirement's so important to you and your clients right there.
I love
and then
that.
one of the sleeves is your bio. So the inside cover will say all about you. And so you can do a customized book. A lot of people just buy the book and they just lend it out, and they have 4 or 5 or 10 of them out all the time, and having clients read them and prospects read them.
If they go out to the site that we've been talking about, or is that a different site where they can say, hey, I'd like to do that? If they
just go to tomhegna.com/advisor, and that's where you get quantity discounts on everything. Advisor OR, you get
perfect.
quantity discounts, yeah.
Well, we're talking, we kind of ended this segment because I'm curious, we're talking about longevity risk. I'm all over that. Yeah. Then we're talking about, the annuity is the solution. That's great. But then we were kind of drilling down, okay, but is there one better than the other? And I know there's a lot of math involved in selection by the client when you design it, but talk a little bit about, SPIA, DIA, and indexing on this.
Yeah, so a lot of it has to do with age. So I think the research would show age 70 and above, clearly SPIA territory. They're going to that product will give you the highest mortality credits per dollar, and would do the best job of taking that longevity risk off the table and paying you the highest paycheck. If you get below 50, that's maybe where the variables and the indexes and that have the that give you some upside of the market, but still give you a guaranteed downside. Okay, so that's the trade-off. You get less mortality credits, but you get the potential of some upside.
Can I stop you there for a second? But when you're comparing indexing to VUL, a lot of people saying, wow, I do have protection here, but on VUL or variable annuities, I don't have protection. When you look at the risk and the math, do you see, yeah, index can overcome these numbers or no?
Well, I mean, you do have guarantees in a variable annuity. I mean, you can have income guarantees. You can even have cash value guarantees in some companies on your variable annuity. So your VAs can give you protection. Your cash value will go up and down with the market, which is different, but you can have an income benefit or a cash value guarantee. So you can have guarantees in the variable annuity. It just, I would say it's really age. So 50 and below, you're looking at more the VA or the index type annuity, 70 and above more the SPIA. And then, and I would say 50 and below the DIA as well. The DIA is a guaranteed income annuity that you annuitize at a future date, but it's got huge mortality credits built into it. So it's a very attractive. Between 60 and 70, it really depends. How conservative is a client? Do they like to take some risk? Do they not like to take risk? Do they want to have that guaranteed paycheck? And so 60 to 70, it's really client dependent, and then 50 and below, you know, some of those other products, the deferred products might look more attractive. 70 and above, I think it's all about the immediate annuity.
Well, what I'm thinking about, we're introducing concepts here to protect the #1 risk in retirement, longevity. When I look at that, I'm thinking, well, you know, we're going to be coming at age 70. Those mortality credits are going to be, well, let's just talk about it in reality. What kind of a rate of return? I mean, because most portfolios are around 3 or 4%, but they're paying more than that.
Well, so a 65-year-old is going to be guaranteed just under 7% a year. A 75-year-old is going to be guaranteed just under 9% a year. An 85-year-old is going to be guaranteed just under 13% a year. You know, a 91-year-old can be guaranteed up to 20% a year. And so it depends on your age is where you get the mortality credits. But here would be something I would say to your securities representatives. Many of them get compensated on assets under management, and they're very concerned about taking money out of their assets under management. They don't want to commit a nuicide as such. Every study I've read shows that you get more assets under management. And look, my personal experience working with registered reps from around the country, any advisor who does this, who uses an annuity to cover basic expenses and optimizes the rest of the portfolio, they all have more assets under management, not less. Because when you're doing what's best for the client, good things happen to you. They come up with the other money they never told you about. Their brother, their neighbor, their cousin, their uncle, their aunt, their grandma. You start getting all of this other referral business. And so the advisors who buy into taking that longevity risk off the table, they do not commit a nuicide. They increase their assets under management, and there are research that will back me up on that.
When I first read Tom's book, he started using a phrase that I find fascinating. It's not that these other assets don't deliver some income or some kind of goes out to maybe 80, 85. The problem is it's not optimized or it's not optimal. You use this phrase. I've heard you in your speaking. I've seen it in your book. Talk a little bit about why this is so important to understand the word optimal.
Well, because if somebody says, Tom, I don't believe you, I'm not going to use an annuity, I'm going to use a stock portfolio, real estate, or whatever, math and science would prove that that's suboptimal, that it's less than what it could or what it should be. See, one of the neat things, and I was just doing some things this weekend on updating some of my slides, there was an article that said the annuity protects you from underspending. See, we always think it protects you from overspending, which it does, but the real thing is it protects you from underspending. What does that mean? That means if you don't use an annuity, you're going to put your money in a portfolio. Morningstar now says you can take out 2.8%. So you're going to take out 2 to 3 to 3.5. You can't take out 4. 4 fails. So you're gonna live a suboptimal life because you're going to try to live on 3 or 4%. Seriously, when you could have had a 7 or 8% guaranteed payout rate for the rest of your life. Suboptimal.
Suboptimal versus optimal. That's all here in this book. It's really quite fascinating thought. Well, that's our show for today. You can read all my online insurance news commentary, advisor blogs, and articles on Producer's Web, and my answers to consumer questions on theinsurancelibrary.com. And don't forget to view all our past episodes right on our on-demand section at downtobusiness.ashbrokerage.com. So follow me on Twitter, Facebook, LinkedIn, or just email me, steve.savant@ashbrokerage.com. And remember, you could be wiser as an Ash Brokerage advisor. We'll see you tomorrow with Tom Hegna.